Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I want to talk about something that's on everyone's mind, and that is refinancing. There's been a lot of talk about interest rates coming down. They have come down a little bit. They're not, I don't think, anywhere close to where they're ultimately going to be, but lots of talk about refinancing. Look, if you're in the mortgage and real estate space, for the last 2 years, we've been telling people, hey, you can purchase a home now and refinance when interest rates get better. And a lot of people are feeling like we're getting very close to that time when you should refinance. Matter of fact, if you have as many mortgage people on your social media feed as I do, all I see is people reaching out on social media. Hey, if your rate's below or if your rate's above 6.5, DM me. And if it's above 5.5, I mean, I see some crazy rates out there. I'm not going to give a rate quote today because there's so many factors involved, but I will tell you that interest rates are not in the 5.5 range, and more than likely in the mid to upper sixes still, with certain scenarios, depending on credit scores, still being in the sevens. Like, let's be honest, especially if you're doing cash out, things of that nature, where you're not going to get the very lowest rate that might be available. So what I want to talk about today is when, why, and how you should consider refinancing. Now, this is not a solicitation for refinance business. I don't even originate loans myself. I am a licensed mortgage originator. I am a certified mortgage banker, but I'm not looking for your individual business. So this is an episode that I think could be shared with anybody. This is more consumer facing, but things that real estate agents and mortgage professionals should be communicating to their clients. And maybe you're watching this because someone sent you this if you're considering refinancing. I'm going to walk through the things that I would take a client through as far as evaluating the right time and method in which you might want to consider refinancing. So let's start with the why. Why would someone refinance? And, it's like so many other things. I think a lot of people just think, well, everyone else is doing it. Everyone's talking about it, right? And I will just start off by saying refinancing because you think it's what everyone else is doing is not the right course of action. Now, is it something you might be hearing about and you want to have an evaluation done to see if it's right for you? Sure. I think we're probably getting close to that time. I would even say it's probably a really good time to engage with your trusted mortgage professional that you do work with and have a conversation about identifying the right strategy for you for when interest rates get to that level, even maybe identifying a kind of trigger rate, a rate that you want to get to in order for it to make sense for you to refinance. But here's some things that you need to consider around why you would refinance. First of all, the obvious one is lowering your monthly payment. And that may sound obvious, but there's a lot of factors that could go into that. Obviously, the interest rate plays a role in that, but so does the term of your mortgage. Some people's goal is to be debt-free by the time they retire, for instance. And so you might want to look at the time span in which you'll be earning the kind of money you make today and then make decisions based on the duration you have left to make a mortgage payment comfortably with your current income. Another factor is, are you going to be able to remove mortgage insurance? Most mortgages that have less than 20% down, whether they're conventional loans or government loans, have some form of mortgage insurance. On government loans, on FHA in particular, that mortgage insurance does not go away when you reach a certain loan to value. It's for the life of the loan. So refinancing to lower your interest rate a little bit might make more sense if you're also at the same time able to remove mortgage insurance. And this then plays into what's the loan to value ratio of your loan. What's the value of your home? How much equity do you have? And so as we think about our time horizon, we need interest rates to be, at a level where it makes sense, but we also need potentially the value of your home to be at a place where it makes sense. And those are things you'll have to consider and evaluate. Do you have, what I would consider bad consumer debt? Do you have high interest rate debt on depreciating assets or credit card debt, things of that nature? That would be something to consider and talk to your mortgage professional about does that fit into your overall strategy? For many people, it does not. There's many cases where you could tackle paying off your debt using the snowball strategy or other ways of focusing on not accumulating more debt and putting extra payments towards the consumer debt you have. And that might make more sense for some people than utilizing the equity in their home and spreading that over 30 years. For other people, sometimes paying off of debt and in conjunction with lowering their interest rate is really a strategy to actually pay off their home quicker, because you take the monthly payments that you were paying on your consumer debt, which is typically much more per dollar owed than it would be on a mortgage, and then you actually apply the same amount of monthly expense you've been paying, but you apply it all towards that new mortgage and shorten your term drastically and really completely restructure your overall financial situation in, 15 years, as an example. You could be in a totally different place. You could be debt-free, both with your mortgage and your consumer debt, by incorporating a strategy like that. So that's definitely something to consider. Paying down your balance. Some people have come into some money. They've liquidated some of their other investments. Maybe they had an investment property that they recently sold, and now they want to pay down their mortgage and be more prepared to have a house payment that fits their needs now moving forward, or like I said, into retirement. In most cases, if you're just looking to pay down the principal balance, you don't need to refinance. Many lenders will allow you to do a one-time or even multiple-time large principal reduction with a reamortization so that your payment comes down accordingly. Now, the interest rate's going to stay the same, but that's something that many people might want to consider if all you're doing is trying to reduce or pay down the balance of your loan. Some people are in a situation where they need to remove someone from title. This happens when there's been a divorce situation. You purchased a home with partners and that partnership has since dissolved, or any number of reasons. Like, keep in mind, when you get divorced, even if there's a quitclaim deed that's executed and someone is removed from title, they're still obligated on that mortgage. And most divorce settlements will require at some time in the future, if not immediately, that that person be removed from that mortgage debt obligation, because it could impact their ability to borrow funds in the future or have to continually document that there was a legal divorce or separation and they're not responsible for that. So removing someone from title is a major factor for some people when it comes to refinancing. And the last thing I would mention is that sometimes a refinance isn't the right strategy for these situations. Maybe a debt consolidation by utilizing a home equity loan works better. A home equity line of credit or a home equity fixed rate mortgage are all things that you should consider in your why behind refinancing. So the next question, and I think the bigger question, is when? When should you consider refinancing? Like I said before, probably not just when everyone else says that it's the right thing to do, but you need to find the situation that works right for you. And, I've been doing this line of work now for 27 years. So I've seen some refinance cycles, and I've definitely figured out that there's some right ways and some wrong ways to go about refinancing one's mortgage. And one thing that I recommend people do is you could actually refinance multiple times as interest rates come down, but there's a caveat. You want to do this in a way that doesn't significantly add to the principal balance of your mortgage. So many people will call this a no-cost refinance, and I want to be crystal clear. There is no such thing as a no-cost refinance. Matter of fact, there's even rules and regulations around advertising of no-cost refinances, although I see people do it on social media all the time. There's always a cost associated with refinancing, but what you can do is, instead of taking the very lowest rate that's available, you could take a slightly higher interest rate than that and use what they call rebate, use some money that the lender would pay to cover those costs that are associated with refinancing. So therefore, created a situation where you're not bringing money into closing, you're not adding those costs into your principal balance, you're just not getting as low of an interest rate as maybe you otherwise would have been able to obtain if you didn't use those funds to pay closing costs, or even if you went on the other side of the spectrum and you decided to pay discount points to actually buy that interest rate down. So with that quote, no cost strategy, which as we mentioned isn't no cost, but it's referred to that a lot. If you're able to refinance in a way that does not increase your principal balance, even if you're saving a small amount of money, it may make sense for you to do that. And you could do that multiple times as interest rates come down over the years. Now, we don't know that interest rates are going to come down over the next couple of years. I mean, it's highly anticipated that that's what's going to happen. So some people might say, well, look, I don't want to wait it out. I'm not a gambler. I mean, if I can save some money on my mortgage, let's do that today. So just be careful when you do that you don't pay a bunch of costs and fees, because if rates continue to drop even lower and you want to take advantage of that again, now you're going to have to pay those costs again, or all the money you spent to do the refinance is kind of wasted. And you might even owe a significantly more on your mortgage than you did before, making it more difficult the second or third time that you might want to take advantage of lower interest rates. So this is a really big one that people need to have, an understanding of, but really talk to your mortgage professional about how they're structuring your refinance and how much is it increasing the principal balance of your loan. Now, if you feel like, look, interest rates are improved by a point, maybe they're a point lower than where you're at today, or maybe they're 2 points lower, I don't know. Let's just say you're happy with that number and you want to pay discount points and get it even lower. Then I'm not saying that that's the wrong answer. I'm just saying that there's a lot of cost associated with doing that. And there's going to be a break-even point that you need to calculate on, okay, how long do I need to stay in this mortgage for these costs and even additional points that you may pay to buy the rate down? What's my break-even point on that investment? And really know and understand what that is, and realize that if you sell the home or refinance before that break-even point, some portion of the expense that you paid to refinance is kind of money that you wasted if you don't stick to that time horizon. So to sum it up, and I know this can be complex, especially for consumers who don't do this all the time, the reality is you can structure a refinance in a way that adds very little to no money to your principal balance. And if you do that, even if you save a nominal amount monthly, then you could do that multiple times as interest rates come down and really not be any worse off for the wear, because you haven't added to your principal balance. The costs that were associated were paid for through the interest rate, essentially. You wouldn't have got the lowest rate that you could have, but it's lower than what you have now, and it makes sense. So that's the preferred strategy, in my opinion, especially given this current cycle and how high interest rates are right now. Chances are that they're going to, start coming down as the Fed starts reducing the Fed funds rate. But we expect that to be a very long cycle. So there may be multiple opportunities to take advantage of that. And you want to think about that when you move into this refinance strategy. Here's another thing to really keep in mind, especially if you're looking at interest rates that are posted on what I call rate tables, or really these refinance factories, these online lenders who really pop out of the woodwork during a refinance market. Many times, not always, but many times, they are quoting interest rates that have points associated with them. And the reason they do this is obvious, right? Most consumers focus on the interest rate. So you see, oh my gosh, these guys are at 5.5%, and everyone else is telling me rates are at 6.5%. I should call them. That sounds like a really good deal. They know that the average consumer is going to see that lower rate, pick up the phone and call. but just know that there may be points associated with that, and paying those points may not fit in with your long-term strategy, especially if you plan on potentially hedging yourself against a multi-year decline in interest rates by being able to be prepared to take advantage of it now a little bit, but take advantage again later if rates go even lower. Paying a bunch of points, as I talked about, extends your time horizon and makes that very difficult to do. Doesn't mean it's the wrong choice. It just really needs to be considered, thought out, evaluated, and you need to know where your break even is on that. The other question is, let's say you've taken out a home equity loan, right? So many people during this time of higher interest rates needed equity for home improvements, debt consolidation, whatever the case may be. So now you have a first mortgage and a second mortgage. And I think the normal thought process is well, once rates come down, I'm just going to roll those two loans together. That's going to make it really easy for me. And I think a lot of people, unfortunately, when they give someone a home equity loan, they kind of make it sound like that's easy to do. And it's not that it's difficult to do, but it's not that simple. Because when you have your original first mortgage that you took out, if you just refinance that and lower the interest rate, it's called a rate and term refinance. Once you're rolling in other debt, including a home equity loan that you might have taken after the date that you acquired the property, this is now considered a cash out refinance. And a cash out refinance is a higher risk loan in the eyes of the lender. And so the interest rate is going to be a little bit higher on a cash out refinance than it would be on just a simple rate and term refinance. So even if you have a second mortgage, you really need to then look at what is the blended rate between my first and second. So when you're looking at rolling that together and getting your new mortgage, is it still financially viable to do that? And there are situations where you might actually want to keep the second separate, meaning you would subordinate that second mortgage. You would just do a rate and term refinance on the first because the terms are going to be better. And then your second kind of gets moved out of the way. You refinance the first and it gets put right back in its second lien position, especially if you already have a strategy to get rid of that second mortgage. You wouldn't want to roll it into your first, pay a higher interest rate on the whole thing because it's cash out if you have some windfall of money coming, or if you already had a strategy to really attack that second mortgage and get it paid off in a few years, maybe sticking with that strategy might make sense. So again, these are things that need to be talked about, considered by a mortgage professional when you're looking at refinancing and your overall situation. Now, the other thing I want to mention here about the when is the term of the mortgage. So many people, I would say that an amortization schedule is like the eighth wonder of the world, meaning I don't know who invented it. It definitely plays out very well for banks. But if you've ever looked at your amortization schedule, what you'll notice is that in the first more than half of the 30 years, if it's a 30-year mortgage, a significant portion of your monthly payment is going to interest versus principal. And it's much higher in the first few years. And then as time goes by, slowly you're paying less money towards interest and more towards principal towards the end of the term of your mortgage. And so what this means is that, let's say that you purchased your home 3 years ago, and you've already been paying down your amortization schedule for 3 years. And most of that money, unfortunately, really just went to interest. It didn't pay your principal balance down much at all. So what you might want to consider is talking to your lender about giving you a mortgage that matches the term of your original loan. So for instance, if you're 3 years into it, many lenders can give you a 27-year mortgage. Now, the payment won't be quite as low as it would be if you did a 30-year amortization, but you are going to save all that interest that you would have paid in the first 3 years of that amortization schedule, because it really just, when you take a a 30-year amortization schedule and you make it 27, you're really just cutting off those first 3 years. And the amount that you're paying towards principal and interest is a much more favorable ratio. Still not a great ratio, don't get me wrong, but better than if it was a 30-year term. So many people would want to then consider, when they look at the monthly payment savings, do you want to tie together the current time horizon that you're on with your mortgage and take out a new mortgage with a similar time horizon, knowing that it's going to be a slightly higher payment than a 30-year fixed would, but maybe that's important to you. So again, just something else I wanted to mention that might be a factor in something you should consider in the conversation. For some people, I'll be honest with you, it's really all about monthly payment, and they would be like, oh, if I can go back to 30 years and start over again, as long as that's my lower payment, then that's what I want to do. And I get that. Most people would fall into that category. But if one of your hesitations of refinancing is the starting over the amortization schedule, there are ways around that. Talk to your lender, and most of them should be able to provide you some solutions for that as well. So the other thing to keep in mind is the timing throughout the year of when you refinance. And really where this comes into play is your homeowners insurance and your property taxes. So most people have an escrow account that they pay into monthly. It's part of their monthly payment. And from that escrow account, they pay your homeowners insurance annually, and they pay your taxes based on whenever your state collects for taxes. Most states are twice a year, not all of them. In Washington State, where I live, it's April and October, but other states, it's different times of the year. So when you think about the cost of refinancing, with some situations, especially if you refinance with a lender that services your loans, so if you did your loan with a company and they also collect the monthly payments on it, chances are they can just take your existing escrow account and just leave it in place. So you can refinance. You're still going to have those closing costs I mentioned, but you're not going to have to reestablish that escrow account again. Now, there are some benefits potentially of reestablishing that escrow account. And here's what I mean by that is that if your escrow account has a balance in it with your current lender and you refinance and you build in the cost to reestablish that escrow account, through your closing costs of the mortgage, whatever's in that escrow balance now with your current lender will get refunded back to you. So for some people, they don't want to do a cash out refinance, but man, if I could skip a month's payment and put a little bit of cash in my pocket and still lower my monthly payment, that would be beneficial to me. So deciding whether or not you, in many cases, if you're not refinancing with the servicer, you're not going to have the option to roll over your escrow balance. But even if you do, you need to decide if that makes the most sense for you, because for some people there is some advantages, because you're always going to skip 1 month's payment when you refinance, because you're still going to pay the interest. Don't get me wrong, you're not going to skip paying interest. It's just that your monthly mortgage payment is actually paying your interest in arrears. And so you always have at least 30 days before you make that first payment. And so for most people, that ends up resulting in a monthly payment they don't make. But don't get me wrong, you're paying the interest for every day that you have a mortgage. It just sometimes it's rolled into your refinance. Other times it's paid into through the monthly payment. So that's another factor. Is do you roll over your escrow account or do you reestablish a new escrow account? Many people really don't want their principal balance to go up at all. And if that's the case and you're not rolling over your escrow account, you would need to write a check to reestablish the new escrow account, but you're going to get a refund of what's in the escrow account already. So you're going to be replenished by that. Now, depending on the time of year and depending on if there was an escrow shortage, meaning had you been paying enough into your escrow account to fully account for the amount of your property taxes, there may be a slight difference in that amount. So you may be writing a little bit larger check than the one you're getting refunded, But even if you didn't refinance, that would work itself out. No one's making money on your homeowners insurance or taxes. They are what they are. It's just a matter of how are we, building out this escrow reserve account to make those payments for you. So keep that in mind when you talk to your mortgage professional. But there are ways of doing it both ways. And for some people, it's going to make a difference. So we talked about lowest rate versus no cost. I would just caution people about being attracted to a low rate that you see advertised. At the end of the day, most lenders today are very competitive with one another. So it's less about getting the right rate and more about getting the right strategy. I've just mentioned a number of things that need to be considered when refinancing. Some or all or many of those may apply to you. And I would argue that a well-established, trusted mortgage professional is worth a lot more than an online lender who simply advertises a low interest rate that may even have some points associated with it. So don't be tricked by the bright numbers. Don't be tricked by the rate that's posted in the advertisement. Definitely think about the strategy that works best for you and sets you up for the long term. Keep in mind, mortgage financing is not about, in my opinion, not about just this transaction. It's about working with someone who understands your short and long-term goals and that is providing you with solutions that best help you meet those goals. One other reason that I put a note here, and I forgot to mention under the why on why you might want to refinance, is to purchase other investment property. I don't know where you live around the country, but in certain parts of the country, there's some pretty significant investment opportunities out there. So if you want to purchase more real estate, take advantage of some of the zoning changes, some of the other opportunities that are out there. Sometimes using your primary residence as a way of acquiring that cash to put down on an investment property does make sense for many people. So if you're looking at doing investing, and I would say any kind of investing, but really real estate investing, in my opinion, is when it makes sense to potentially use your equity to do that. That's another reason you might want to consider refinancing. So we talked about the how, right? So the how really boils down to, do you pay points? Do you pay no points? Do you do one of these, quote, no cost refinances where your principal balance isn't going up? That's something to absolutely consider. The term of your amortization is something to absolutely consider. Do you pay off debt or roll in a second mortgage? That's a big one that you really need to think about. One thing I will say about paying off debt, for some people, and this was my experience the first time that I did a debt consolidation loan, and I've talked about this on the podcast, it completely changed my relationship with debt. And what I mean by this is I was a credit card user in my early 20s. I was way outside my means, but I'd gotten into the habit of using credit cards and having debt and being used to it. And I purchased a home in my early 20s, and values went up, and I was able to do a refinance and a debt consolidation, and I paid off all my debt. And since that day, I have never maintained credit card balances since then. It was like a reset button for me. Now, I think that is not the norm. Many people do a debt consolidation, but they don't change their habits around using their credit card debt. And if you're concerned about that, well, you should be. If you don't think that you can consolidate your debt and change your habits around utilizing consumer debt, specifically credit cards, you might not want to roll those into your mortgage, because odds are you're gonna rack that back up again, and now you're gonna have potentially a higher mortgage payment and more debt and no options to deal with it in the future if you've used your equity. So just a cautionary tale that I would throw out there. That's kind of my list, you guys. I wanted this to be a simple conversation. I understand it was kind of complex, but it's because these things are complex. Refinancing and getting a mortgage is not just a simple thing. And if it was, mortgage professionals like myself wouldn't have jobs. We take this very seriously. We're passionate about helping people understand all of these different things to consider, and then finding the solution that works best for them. I think there's a lot of great mortgage professionals out there who love having conversations and helping people solution for these things. I also think there's some online lenders and some other people that are very opportunistic. They will come out of the woodwork during a refinance cycle, advertise the lowest rate, not explain all of these different nuances to people, and people will make some bad decisions. So if nothing else, I hope that this quick podcast give you the things to think about, the questions to ask your lender when you start thinking about refinancing. And if you have someone who's pushing you more towards doing a transaction than they are evaluating each of these areas and how they impact your short and long-term goals, just move on to a different lender. Find someone who cares about what you're trying to do, who will ask you the right questions, and make sure that you're set up for success. So I hope this was helpful for those people that are seeing all the headlines about interest rates coming down. There's a lot to consider before you just pull the trigger. And I hope this was helpful in moving you closer to having the education you need to make the right one for you. If you enjoy this content, please share it with someone. I think that there's a lot of people that could benefit from knowing the questions to ask their lender and thinking about these things before they move forward. And if you are not subscribed to the channel already, please do so. It does definitely help us out. And just know that there's a new episode coming every single Friday at 10 a.m. Pacific. Thank you so much for your time and attention, and take care.